Hello, everybody, and welcome. My name's Tom Vita. I'm a company strategist here at ACCR. I'm pleased to welcome you to our webinar talking about AGL and the Australian energy transition. I'd like to begin with an acknowledgement of country. I'm based on Gudgeonborough country in the Northern Rivers of New South Wales, and I pay my respects to the elders past, present, and emerging here and on all the lands from wherever each of us is joining today. Just to begin with a couple of housekeeping announcements. We are recording this webinar today, and the recording will be available with the slides afterwards, and you're welcome to share that with others. We will have two presentations, and then we will take questions afterwards. So you can ask your questions at any time by using the question box in your Zoom. You can put those in at any time, but we will respond to them all at the end. We have 1 hour for the webinar today, and I'm very pleased to welcome Kevin Morrison and Stephanie Bashir, who are expert panelists, to give their perspectives on what's going on with the Australian energy transition and East Coast gas markets in relation to AGL and other gentailers and so forth. Let me just begin with a little bit of a perspective from ACCR on what's happening with AGL at the moment. The energy transition continues to reshape the Australian energy landscape at varying speed every year, and it remains a highly competitive industry, both in power generation and in gas retail. And over the next 10 years, AGL's business model is going to have to change quite dramatically in order to stay relevant. Now is quite a critical time for investors to be engaging with the company on their transition, on the level of ambition that they're heading for. And in particular, that's around the forthcoming Climate Transition Action Plan, or CTAP for short, which will be coming out in August this year alongside annual results. And it'll be one snapshot of their forward plans with a particularly long-term perspective up to 2050. The 2022 CTAP made some headlines for its commitment to phase out coal power by 2035 or earlier, but it came at a time of crisis and significant upheaval for the company, with a new board and failed demerger and quite a lot of high drama that made headlines as well. Since 2022, the board has bedded in. And the new CTAP may well reflect this new profile of the board, including its new chairman since February, Miles George, and reflect the changed ambition of the company since 2022. The commitment to phase out coal power by 2025 or 2035 or sooner, that commitment remains in jeopardy unless the wider renewables build out increases quite rapidly. The transition relies on going faster in order for AGL to be able to deliver on that commitment. And there are also challenges in the East Coast gas market, which could cause quite significant implications for AGL and for its customers. Another critical factor post-federal election is the policy and political landscape that could either accelerate or hamper this energy transition. And here, AGL's size and lobbying influence is particularly relevant again. Shareholders generally will be pleased that shareholder returns at AGL have stabilised in recent years, but AGL is nonetheless trading at a 20-year low on its enterprise value to EBITDA multiple, which suggests that the market, well, one interpretation of that will be that the market is currently discounting AGL's ability to navigate this transition successfully and create long-term shareholder value. So this new CTAP, from ACCR's perspective, is an opportunity to win back confidence that AGL's decarbonisation strategy is aligned with the wider transition and the Paris Agreement, and puts AGL ahead of the curve and not behind it. To reflect on these, I'm pleased to welcome Stephanie Bashir, who is the founder and chief executive of Nexa Advisory. And then following Stephanie's presentation, Kevin Morrison, who's an energy finance analyst at the Institute of Energy Economics and Financial Analysis, also known as IEEFA, and Kevin specialises in domestic gas markets. We're delighted to welcome Stephanie and Kevin to give their expert perspectives on the energy transition and AGL's place within it. And so with that, I'm pleased to hand over to Stephanie.
Thank you, Tom, and good morning, everyone. Thank you for inviting me for another presentation today. I'll just share my slides, so just bear with me 1 second as I do that, please. Fantastic. So, as Tom said, I'm Stephanie Bashir. I'm the founder and CEO of Nexa Advisory. We're an independent advisory firm on all things policy, advocacy, and strategy on the clean energy transition. Just trying to see if I can work my arrows. Oops. Skipping a few here. Sorry, bear with me. I'd like to start by just going through some analysis that we recently did on the performance of the AG coal power plants, going from the most recent coal power plant that's going to be closing over the next 5 years. So we did a deep dive into Eraring, Collide, Bayswater, and Yallourn. And we did that so that we can understand, obviously, the ministers don't want blackouts, and we just wanted to understand what is currently the performance and the reliability of these AG coal power plants. Starting with Eraring, we found that Eraring basically is a really good indicator, seeing that it's the first to close now that it's extended in 2027. It's got a very poor performance, and the unit experiences on average 3 months a year where the actual units are offline, and that could be predominantly due to unplanned outages, but also planned outages due to extreme weather conditions and maintenance. It is important to note on this that Eraring is likely to be extended for another 2 years due to the uncertainty of the replacement generation and the slow transition. I will skip through these very quickly, but these are really just to show that all of these power stations that are due to close over the next 5 years have significant downtime and unplanned outages that basically span between 3 to 4 months each. And so that's Collide B, Collide C is the same. Yallourn is absolutely on its last leg, and that's due to close in 2028. Basically, it's the annual unplanned outage rate spiked to 42% in 2024, which is quite significant. And then Bayswater, and this is relevant, obviously, for AGL. While it's the second largest coal power generator in New South Wales, Bayswater has significant unplanned outages and operational challenges. And overall, each unit is basically offline for over 2 months each year, which is quite significant for these power stations that the New South Wales government, Victorian government, and the Queensland government are relying on. So what that also does is it results in high price spikes. The unreliability of the coal really does correlate with the price events that we're seeing. We take the New South Wales last summer in October and November when the Eraring power station, AGL's Bayswater, and the Vales Point were all out during what we know is a really peak period, October, November. It created huge price spikes, and it meant that 2,700 megawatts of base load was unavailable during those 2 months. That is a huge problem for energy ministers, and it does create that whole, if you like, uncertainty. And that's where we see a lot of reactions from a policy perspective. So, packaging that up in terms of the reliability of coal, we are still not on track to meet our renewable build out. So the replacement generation that everyone's anticipating in wind, in solar, in energy storage is just not coming on in time to replace the aging coal power stations. And that's a problem. That's a problem for everybody. It's a problem for politicians. It's a problem for investors. It's a problem for the public. It's a problem for all stakeholders and mostly industry and companies like AGL. And the main reason is that the transmission that basically will allow for the renewables to connect and supply the new generation is just not coming on in time. The dates continue to slip and the costs continue to rise. We're seeing huge cost implications when it comes to the transmission projects that are currently in the pipeline and seen as a infrastructure nation building projects, whether they're interconnectors between the states or whether they are intra-regional transmission projects or even renewable energy zones, which are basically hubs of renewable projects that are connected through a transmission line, which the states are really banking into as a means to build things faster. What that all means really, and this is the modeling we did a couple of years ago, and then this really hasn't changed in terms of results, is that the further we delay the transition and the replacement of renewables of our coal power stations, the more reliance on gas we will have, and we will continue to rely on unreliable coal because even if they were maintained, and these things are very costly, and proponents and owners of these coal power stations are less likely to continue to spend money on them. It means that there is a huge reliance on gas, which is a very expensive plan, and it does result in higher prices. And these higher prices, we're already seeing them now. We're seeing the higher prices because we're already in the year 3 delay based on our analysis, and we're seeing the bills go up. We saw the bills go up in the DMO recently that was published, the default market offer. We're seeing the bills go up in price increases, and there is a huge driver for that, which is the delays in the energy transition and our continued reliance on aging coal and unplanned outages. That is actually not very good news for companies who are in the energy transition today, who are providing these assets. One of the key things is, whether it's investor certainty or predictability. One thing we know is from a predictability perspective that energy ministers of the day don't want blackouts, and that means that they're currently under pressure to respond to a lot of the the drivers of high prices. So there's three things that we know will cause energy ministers of the day to react, and most of the time there are knee-jerk reactions to ensure that they can manage high price spikes, energy reliability, and ensure there's no blackouts and energy security. And in a cost of living environment, and with the global tensions that we're seeing, these three priorities for ministers become even more acute. And these are three things really that a company like AGL absolutely can and has influence over. Whether that's ensuring that they can continue to push for ambition, to close down the coal power stations that they own in time, whether they continue to support energy ministers to push for that orderly closure and an orderly transition is going to be really important. Otherwise, the consequences really is policies that potentially might not be in AGL's favour. But there are opportunities. So the clean energy transition, while it's slow and there's a lot of challenges and uncertainty, there's absolutely a lot of opportunities in the energy transition. And we start with, I guess, the strong pipeline of investment that is absolutely in progress today. Across the NEM states, Queensland, New South Wales, Victoria, Tasmania, we have 70 gigawatts of renewable and storage projects that are in the pipeline. What we've got there is across the states, what's happening between the different states and what is proposed. But you could see here there's 30 gigawatts of solar, 15 gigawatts of wind, 25 gigawatts or gigawatt hours of large-scale battery storage. And that's a huge opportunity. And the question is, where is AGL in this pipeline? Because that's where the future is. The other huge opportunity is in the consumer space. Consumers continue to drive the energy transition through rooftop solar, batteries, and the uptake of electrification and EVs. This is a recent analysis we published only yesterday. There's $20 billion that have been invested to date since 2013 by consumers in rooftop solar. 1.5 billion of that is already invested in behind-the-meter batteries, and that is predicted to continue to increase over the next few years, especially with the federal government's home battery scheme. The home battery scheme, what we calculated is that consumers will invest another 11.7 billion over the next 5 years as a result of the scheme that was announced by the federal government and which will be effective from the 1st of July this year. So what does that mean? It means that it presents an opportunity for VPPs and embedded energy storage solutions and embedded energy storage services that companies like AGL can provide. The coordination of distributed energy resources, though, does need quite a bit of focus in building trust and value. And both of these things do require quite a bit of attention for VPPs and embedded storage to actually take off in any meaningful way. The issue will continue for the battle for control. Electricity monopoly distribution networks are continuing with their plans to cannibalize this space. They are looking for and lobbying to get rid of rules that allow them to enter competitive markets as regulated monopolies. That's a huge issue for companies like AGL, other retailers and aggregators. They want to control people's assets. They want to basically be in the driving seat of the controlling of inverters, whether it's for community batteries, EV charging, and home batteries and business batteries. And at the moment, there is a huge push across the gentailers, retailers, manufacturing organizations, charging point operators to pull together and push back on this issue. And one of the key things that we see is a huge untapped potential is the commercial and industrial consumer energy. This is where we think, as you can see in this graph, the residential uptake of PV batteries, VPPs, is quite significant in comparison to what's happening in the commercial space. The commercial viability of VPPs in the C&I space continues to basically be the driver, but it does require leadership from organizations to push through what's needed. We've got third-party aggregators such as Dexis and other organizations that are looking at deployment, millions of battery deployment programs across warehouses and manufacturing plants. But it really is a huge untapped potential, especially for companies like AGL, where they own a huge consumer base in that space, and they do have the front foot in that space. But the risk of becoming irrelevant is real. The advancement of technology, the advancement of data centers and big data has, been a Kodak moment for many organizations in the past. And AGL is not immune to that. The slow and incremental leadership versus ambition and value creation leadership is going to be a really critical moment. When we look at the opportunities, whether that's the massive pipeline of clean energy investment to replace aging coal, whether it's the consumer energy opportunities, especially with AGL's massive consumer base, both in homes and businesses, it really puts AGL in a position where they can be more ambitious to drive value creation for their customers, for their investors, and really drive the policy predictability that's needed at this moment in the energy transition. Thank you. I'll leave it there.
Thank you so much, Stephanie. Appreciate that pithy digestion of an enormous amount of change in an enormous market. Yeah, thanks for giving such a rapid summary. I'm sure that will be generating some questions. So just a reminder to all of you joining us, if you have any questions that you'd like to ask Stephanie or Kevin or ACCR, feel free to put them in the Q&A box and we will come to those at the end. I'm now very pleased to hand over to Kevin Morrison from IEEFA to talk about East Coast gas markets and touch a little bit on how those relate to AGL's forward plans. Over to you, Kevin.
Yeah. Thanks, Tom. Just give me a moment so before I share my screen. Is that coming through?
Yep, looks good, Kevin. Thanks.
Okay. Yeah, my name's Kevin Morrison. I'm a gas analyst with the IEEFA, the Institute for Energy Economics and Financial Analysis. Most of my work has been on the Australian domestic market, but I do, given that most of our gas production is exported overseas, so I do look at the LNG market. But this presentation will just be mainly focused on the east coast, where AGL has most of its gas assets. So, right. Sorry, just give me a minute. It's not. Okay, here we go. Right, here we have the East Coast gas market, and what we've found, really going back to when LNG exports started out at Gladstone in January 2015, we've seen a decline in the domestic gas market by about 32%. Which is the exact amount it rose in the 20 years before export started. So before export started, domestic gas demand was increasing. Since they've started, it's been going down, and the clear sort of a correlation there is the price, because before export started, roughly the gas prices were trading around $4 per gigajoule, and since then it's just gone up. It's pretty much tripled. So on average, I mean, obviously there's a lot of volatility, but we're looking sort of at prices closer to $11-12 than $4, and two structural issues. The gas supply, most of the cheap gas has been extracted, and so therefore, what we're looking at in the future is really high cost gas. So we're in a market where prices are going to be higher, and also the competition for alternative sources, such as what Stephanie's just presented on with renewable energy, that's posing a lot of threats to future demand. And also, just bearing in mind, we've seen this decline of 32%, and the only real policy we had on the energy transition, I guess, was the renewable energy target. That's we've had a few bits and pieces around it, but what we're starting to see is a lot more policy development, and we saw this morning the Victorian government come out with some more initiatives, largely aimed at the household sector, which is market. AGL has most of its domestic gas exposure to. So just where is the declines in gas demand been? Just on the left-hand side here, a lot of it has been in electricity, because with the growth in renewables, that has largely eaten into gas, as well as coal. So between 2012-13 to the last financial year, there was pretty much a decline of 60% in gas volume, and that's at the same time the share of gas for power generation on the East Coast dropped from around 11% to around 5%. That is expected to bounce back as more coal-fired power stations close over the coming years, but it's not going to go back to the level that we saw at the early 2010s, because what the role of gas, obviously, in the future power system is that of just a more affirming role rather than a base load role. So it'll be the utilization of gas will be far lower than what it has been historically. So yes, maybe we will see a bounce back there, but that's really the only place we're really going to see an increase in gas demand so far, because on the manufacturing front, unfortunately, the high gas prices has sent a lot of manufacturing plants to the wall. I mean, it's contributed to there's been other factors, of course, but the high gas price hasn't helped. So unfortunately, that we've seen with those closures, we've seen a 24% drop in demand. But funny that well, it's not funny, but the AEMO in the latest GSU, they're forecasting industrial gas demand to remain flat, which is we feel sort of highly questionable, because there are still, with the threat of prolonged high gas prices, there's still a lot of businesses out there that are finding it. difficult to digest these elevated gas prices. And at the same time, new technology with industrial heat pumps, you're having sort of some, particularly on the food preparation side, which is quite a significant market on the industrial demand side. They're looking at industrial heat pumps. We can get some temperatures up to about 150 degrees. So, we could see some substitution there. But yeah, so the bottom left-hand chart, that just sort of shows you the role that the prices has been playing in all of this. So where does the gas go? Most of it, as I said, goes overseas. Exactly 73% is exported, but another 7% is actually consumed at the liquefaction plant, to actually the whole energy required to chill the gas so it can be shrunk and loaded onto LNG tankers and shipped overseas. And then 17% is really domestic, and that's sort of the manufacturing, which is still the largest demand base, electricity and the households. And the mantra of the gas industry is we just need new supply, but we've had new supply. We've had record supply. The amount of gas the East Coast is producing is at near record levels, and we haven't seen any fall in gas prices. So that line of more supply, lower prices hasn't worked on the East Coast for over the past decades. In the future, this is data that's taken from the latest GSU, and so what we're finding the household, which is the blue area at the bottom, that's where we're seeing the biggest decline. This is going out to 2044. So we've already seen a decline in that area, particularly in recent years. As more households they have the solar PV on the roofs, they have the batteries, they're getting heat pumps, and so we're seeing that in some of the data that the Victorian government is releasing through its energy certificate scheme. So that's just anecdotal. We haven't got sort of hard numbers on that so far, but the trend is it, and also what they released today, we did get a bit of a sneak preview at it, and they are forecasting much deeper declines in gas demand than what the GSU has put out. So I did a quick sort of calculation. It's not reflected in this chart, but I did a quick calculation. And if we stick to just what the AEMO was saying in their latest GSU, they're looking at gas demand on the East Coast falling by another 18%. I mean, just a reminder, we saw a 32% decline, in the 11 years up to 23, 24. But the AEMO is saying no, it's only going to be 18%. So they're not seeing it as steep a decline over 20 years, which I have to sort of question that, but nevertheless, I'm sticking with their numbers. But if we add in what the Victorian government is now proposing, we could actually see that decline up to about 30%. Now, this is provisional. This is not a hard number. It's just I saw a screenshot of the decline, and I'm just working off that. So it's I wouldn't bet the house on it, but it's just a provisional number, and it just gives some idea that there are further demand reduction measures coming through, and that's just one state government. I mean, New South Wales haven't gone anywhere near what the Victorian government has done, and neither has Queensland. So there is potential scope for more demand reduction. As I said, moving on to the industrial sector, it's just forecasting consistent demand, which I do find sort of hard to digest, given there is still a number of industries that are quite vulnerable to the high gas prices. Just for example, we've got 2 petroleum refineries still left on the East Coast. They're being subsidised out to 2027. It's whether those subsidies will continue. It's a sort of questionable, but that's just one example where we could see further reductions in industrial gas demand. And the third customer base is the gas power generation. So we've seen a steep decline there, but AEMO they've been forecasting for some time a bounce back as more coal-fired power stations close, and that sort of bounce back is really going to pick up in the 2030s when we'd see far more coal capacity coming offline, or it's projected to come offline. But there's still, we've seen a big investment in batteries. So whether that bounce back will be as much as what AEMO is predicting, that's we're still yet to see. But the actual biggest, if it wasn't for electrification, gas prices could be a lot higher. This is so we should thank the initiation in electrification for saving the gas market in a way, because this again is using the latest GSU numbers, and I'm just sort of, we've really been looking at the step change number, and so if we just look at that, what we're seeing, what AEMO predicting is by 2044 around 175 petajoules of potential gas demand will be electrified. That is a significant number, given that the size of the East Coast gas market is around 500 petajoules a year. So if we look at by the end of this decade, 2030, we're roughly looking at about 50 petajoules. And that is significant, given the fine balance we're sort of treading towards in the East Coast gas market as production from the Gippsland Basin starts to decline, and bearing in mind, the Gippsland Basin has been predominantly satisfied most of Victoria's gas needs, which in turn is the largest gas consuming state on the East Coast, excluding the gas used for LNG exports out of Queensland. So it is a very significant market, and again, this is where AGL has more than 50% of its gas consumers, by volume I'm talking, not by sort of numbers, and in turn the consumer, AGL's consumer market is about 50% of their overall gas business. So it's a really quite a critical market for AGL. And this is why I'm talking about the fine supply, because this is data that's really provided by Exxon, the operator of the Gippsland Basin joint venture, the largest gas producing facility off Victoria, and this is what they're looking. So their gas is all processed through the Longford gas plant. They've already shut one unit, so they've already lost a third of their capacity, and they're looking to shut another unit in the early 2030s and really completely shut up the shop by 2033. But that's what they're saying, and they have forecast in the past that there's no more gas, but even this week there was a report in the Australian newspaper that the joint venture has found about 92 petajoules. So it may not be running out as quickly as what they've forecast, and there is also a renewed interest in the Otway Basin. But whatever they find, it won't be anywhere near the gas volumes that's been extracted in the past. So all it will do will just be incremental, and maybe just push out the supply shortages. But nevertheless, we are seeing a structural decline in gas supply from offshore Victoria. So and it's projected to fall at a steeper rate than electrification or the reduction in gas demand. So that's why AEMO is forecasting these gas supply gaps to occur from 2029. But the Victorian government's measures that they're announced this morning, they're saying that those gaps will be pushed out by at least a year, so it really could be 2030. And we've also just looked at what some of the other alternatives. By the way, we should not really be talking about any gas shortages whatsoever, because there is enough commercial gas reserves, that is 2P, that's proven and probable reserves, which is the measure that companies use on their books to say this, we've got definite gaps in place to supply the market for example. And so what they have, what the East Coast gas producers have, is about 16 years of gas supply, just based on last calendar year's gas consumption. So it could actually be more if I didn't do the calculation based on the forward gas demand, which is projected to fall. So we actually could have a bit more than 16 years, and that's not including just what the Woodside and Nexa just found in the Gippsland. So there's, as I said, there could be possibly more there. We've also had the Victorian government, they're looking to sanction a renewable gas target. Now that is really largely biomethane. I completely dismiss green hydrogen. That is not economic. It's just a smokescreen, really. But I've spoken to a number of biomethane potential producers, and they seem quite serious about it. And Victorian government said put a target of about 4.5 petajoules. It's not going to change the moment, but all these measures, they still make up. They can still help fill the gap. Other work that we've done, we've looked at methane capture, because there's been a underreporting of methane leakages in Australia, and that contributes obviously to greenhouse gas emissions. And so there has been estimates. We haven't estimated, but we're just sort of taking this to the likes of Rystad. They've estimated that there's around 80 petajoules in the gas supply system in Australia of methane leakages each year, which is a significant amount of methane being leaked, and that is, given its greenhouse gas factor, it's very potent, and if we don't address this, it's going to make up a larger proportion of our greenhouse gas emissions. So it is something that we should be looking at. And furthermore, what also the IEA have said, the International Energy Agency, is that the measures taken are economic. Based on the gas price and the carbon price. So, companies should be looking at this. And if they did, on the East Coast, we estimate that there's probably about 24 petajoules of gas that could be recovered through enhanced methane capture. So again, it's not going to alter the market, but it's going to help sort of plug those gaps. Other measures, just to discuss higher rates of electrification, and even if it's just one of the liquefaction plants up in Gladstone was to electrify, that could be a significant saving, given that those three LNG plants up in Queensland, they consume about 120 petajoules a year. That's a fair amount of gas. So I can't see them all electrifying. I'm not even sure even one of them will electrify, but I'm just saying that there is that potential. The other thing some work we've been doing recently is that we feel that there's scope with the AEMO's forecast of supply gaps from 2029, although the Victorian government's now saying 2030, we feel those gaps could really, the most economic way that they could be filled is the redirection of some of the cargoes that are sold on the spot market. Now, that's completely different to the cargoes that are sold under long-term contracts, because we don't want to break any long-term contracts. We don't want to Australia to become an international trading pariah. And so with the spot market, that is discretionary sales, and where it's sold to the highest bidder. Now, if there was an incentive, and we feel something like a taxation to incentivize that gas, instead of being loaded onto the ship to just being pipe down to the southern markets, we feel that could really would fill some gaps. So yeah, the studies that we've done is that I mean, this is both the East Coast and West Coast we're looking at. But if we're just on the East Coast, there's about 87 petajoules of gas that is sold on the spot market. And that would help, really fill some gaps. I mean, we're looking at a gap of 57 petajoules, but by the end of the decade, so that more than fill that. But it won't be enough to fill the gap by 2033, 130. But some of those other measures, it goes a long way to help bridge that gap that AEMO are forecasting. The other reason why we feel that this is probably the most expedient policy is because when we look at it, when I just going back to the commercial gas reserves, 90% of that is in Queensland. So whatever we do, we really can't ignore Queensland. And the problem is that most of that 90% is controlled by the three LNG consortiums. And so there is. This is why I go back to my point about, there really should be no gas shortages because there is plenty of gas. But the problem is it's just controlled by a handful of producers, and that's not really good in any market. And so that's why we feel there is certainly too much of our gas is going offshore. That there should be some incentives to bring it back to provide energy security particularly for the industrial sector, which. It's as we can see, it's slower to transition, and we don't want any more factories closing down because of distorted gas market. And I guess the East Coast provides the East Coast gas market provides a cautionary tale, but yet Western Australia, which we've kind of looked to as a good example because they haven't had the price increases that we've had, but now given some changes to their gas reservations, such as onshore gas projects are now allowed to export through LNG. We're starting to see, well, AEMO now sort of come out with potential shortages there, which again should not be the case. And we go back to the previous slide I had, where there's much more LNG sold on the spot market from WA LNG plants. There's plenty, there's more than enough there to fill those supply gaps. And new sort of what's on the in the planning stage. There really isn't that many projects, new gas projects that. Okay, we've got the Northwest Shelf, but most of these gas projects, they're all earmarked to send the gas overseas, and here on the East Coast, APLNG, they're applying to extend their gas projects up to 2061, and thousands of new petajoules. But again, they're not talking about that going to the domestic market. That's all for export. So that's why we feel there should be some sort of policy changes in terms of we've got the gas, but we're not directing it to and looking after the domestic customer base. So that's pretty much my presentation. Thank you.
Thank you so much, Kevin. That was very thorough and interesting to compare those east and west markets and the directions they're heading, and some of the solutions similar, some different. We've had a number of questions from panelists, so we'll just move on to take some of those. We've got about 10 minutes left, so obviously some of these questions one could write a whole book about the answer, but if we can try and keep the answers pithy, then we'll be able to get through as many questions as possible. And one of the first questions is about coal, and the question is, what can AGL do to ensure that coal closes on time, or is it just dependent on a transition that's going too slowly and there's not much the company can do about it? I guess, Stephanie, what are your thoughts on?
Yeah, that's a very good question. We could say that AGL can't guarantee perhaps the closure of Bayswater and Loy Yang. And it might depend on where ministers are at the day and the reliability gaps. But AGL does have a huge role to play now in the immediate short term and medium term in pushing the replacement generation build out. And, as a large organization, um, AGL does have quite a lot of influence with governments. And so, there is a big responsibility for the large organizations to make sure that there is certainty in the closure dates. And at the moment, the reporting on the closure dates isn't a regulated date. The proponents do provide the date to AEMO so that they can do planning and forecasting around it. But, the orderly closure exit of coal is one of the biggest signals that to investors in renewables and more importantly in energy storage. And if we had that certainty, energy storage investors and developers have actually said in a number of interviews with us that that would be their biggest signal to invest. I could go on a bit more, but I might just stop.
Great. Thanks, Stephanie. There's lots to say about coal closure schedules and their certainty or lack of certainty, which stakeholders that serves and which it doesn't. But I think that was a good answer to that question. A second question we've had, also for you, Stephanie, I think, what should Associate Professor Nelson do for electricity markets? I guess this is referring to the current review. So I know you have lots to say about this, but any quick thoughts?
Yeah, I'll keep that one short. I think there's a huge opportunity for the NEM review, which is being called the Nelson review, to take a really good look at not just the wholesale market, but also the underlying blockages of the energy transition. However, the scope of the review is now really kind of succinct to short-term spot market, medium-term derivatives market, and the long-term investment, and ensuring from a financial and contract perspective that some of the, if you like, there's improvement in the contract market and it's incremental rather than substantial. And that incremental mindset, and I think it's supported by AGL and some of the other gentailers and some of the other larger companies, is really going to hold things back. And this is where, we really need to have more ambition and look at things from a value creation just for consumer retention, consumer acquisition, but also to build the trust as we're going through the clean energy transition.
Thanks, Stephanie. And am I right in thinking Nexa has published or will be publishing some perspectives on the NEM review for any investors who want to look into it more deeply?
Yeah, we actually did a report before the NEM review consultation started, which I'm very happy to share. One of the things that we have actually proposed in that from a long-term solution is a strategic reserve where investment can go and be valued in a strategic reserve that would provide ministers with the insurance and I guess the replacement capacity when things go wrong. And that's exactly where we know ministers will react. And that's something that, will provide. When we know what ministers will respond to, we can actually set some policies in place and drive certain outcomes that ensure that gives predictability and that certainty that ministers will need.
Great. Thanks, Stephanie. A question for you, Kevin. What should governments do for East Coast DOM gas security and pricing? And I know you touched on it a bit in the presentation, but yeah, just interested if you've got any quick thoughts on security and pricing.
Yeah, I think I'd like to go back to what I was saying about the redirection of gas from the spot market again, because that they are discretionary sales. They're not interfering with long-term contracts, and if the government was to come out with a policy that would give security, it would also provide. I mean, the likes of I should have also said, the likes of APA, in terms of that they've got plans to increase pipeline capacity. I understand that they're going ahead. Nevertheless, we've also got the Port Kembla Energy Terminal, which is a import terminal. They're talking about 2027 to start up. That's again, that's already built. Gemina, the operator of the Eastern Gas Pipeline, which connects to Port Kembla, they are going to be working on bi-directional, because at the moment that gas just flows north from Victoria, but now the gas will be able to flow south. So, they're some of the things that are already on the way. But we feel that if the government was to do something on it, whether it's they call it a gas reservation policy or just some measure to such as what I've suggested, taxation on discretionary spot sales to encourage that flow back into the domestic market, that would provide some certainty. It would also provide, sort of the likes of APA, and we've got sort of a couple of initiatives to expand energy gas storage, which is also critical given particularly in the winter periods, as we won't be relying so much on the Gippsland Basin gas, because that won't be there in the future. So all these initiatives, I think that would provide some incentives, so that would therefore provide some security if the government was to act upon the spot LNG sales.
Great, thank you, Kevin. And I can certainly recommend IEEFA's various publications on this point for more detail. But thanks for that response. Here's a question, I think possibly for both of you, or whoever feels like taking it. Is there going to be enough generation to meet the increased demand from growing electrification?
Perhaps I can have a go and then pass it on to Kevin.
Sure.
I guess this is where currently a lot of the network's underutilized at the distribution end. We know that for a fact. So that's one key thing. The other thing is at the moment also with the uptake of rooftop solar and batteries, both at the home businesses and increased large scale, that basically helps balance in terms of supply and demand as we move forward with the high uptake of electrification. Of course, as well, we've got electric vehicles coming in, perhaps not as fast as we'd like them to come in. But again, this is where energy storage plays such a significant role. And, this is where AEMO's forecasts for the need for a capacity of 22 gigawatts by 2030 and 49 gigawatts by 2050 comes into play. Today, we've only got 3 gigawatts. So there's a huge opportunity for investment in energy storage. And that is where I think the next big boom will be, and where it is being played at the moment.
Yeah, I endorse everything that Stephanie said. My colleagues on the electricity side, that they've been doing a lot of work on distributed energy resources. We feel there's a lot more that could be done to utilize the capacity at the distribution level. So yeah, definitely, and also furthermore with the renewable energy zones that New South Wales is creating, that provides a lot of opportunity at the transmission level as well. So yeah, that's again just endorse what Stephanie said. Plenty of opportunity.
Great. Thank you both so much. We're just on the hour, so just remains for me to thank Stephanie Bashir and Kevin Morrison for joining us today, and to thank all of you for your participation and questions. Just a heads up that AGL's Climate Transition Action Plan is due out on the 17th of August, and it will be put to shareholders for a say on climate vote at the AGM, which is on the 3rd of October. So the coming weeks and months are a really critical time for investors to engage with AGL, and ACCR certainly here happy to support any of you. We didn't manage to cover all of your questions today, so if you want to talk further about AGL, please do get in touch with us, and of course with Stephanie and Kevin as well. If you want to take any of that further, I'm sure they'd be happy to respond. So thank you all so much, and goodbye.